For those of you wondering why the Treasury rates and government bonds have been dropping in the past few months, I'm going to give you my take on it in this video. So since about April to March of 2021, your bond interest rates have been dropping. So this is the 10-year Treasury rate, which is often most looked at because it tends to be that core vital interest rate in the middle of long-term interest rates and short-term interest rates that investors and market analysts tend to focus on to give you kind of a perspective of where the general trend of interest rates are going. And just for frame of reference, bond interest rates peaked at about 1.75% around mid to late March, and then they've just been on a downward trend since then. Now, any person who has been a student of economics would note that when you have an increasing money supply, yeah, that does drive down interest rates. But if inflation rates are going up, such as what we're seeing in the CPI, that should logically push up interest rates, because you have to think about it. Any entity that issues a bond out, meaning they create a loan on a bond or buy a bond, is suffering a loss because the real return on loaning that money to the entity that issued the bond is negative. So, for an example, if a bank creates a loan for 3%, but the inflation rate is 5%, then in real terms, the bank's expenses are going up than what they're getting on a return on their investment. And therefore, they're suffering a real loss in those terms. Yet, for the past several months, the inflation rates have been substantially higher above interest rates. And although that can continue for short periods of time, the question is, when are bond interest rates are going to correct? Well, I'm going to give you my take on it. I'm going to show you this chart here. So this is your 10-year Treasury, and I've gone all the way back from 2020 right here. This blue line is your 10-year Treasury interest rate on the bond. Okay, so for government treasuries. Now I want you to note here where it peaked, and I want you to note here when the troughs were made. So this is sort of like a floor. And what I want you to really pay attention to is that the low ends of the bonds, meaning when the bond interest rates fall, they tend to fall at higher and higher levels, okay? So this could be looked at as sort of a rising floor. So giving you a little bit of technical analysis here. This rising floor is telling you that bond interest rates are indeed being pushed up. It's just that when relative to the short term, when bonds peaked so high right here relative to their historical channel, which has been noticed by this trend line. So if you follow this trend line, look at about January, and bond interest rates really started to increase above that channel holding. And the question becomes, why did those bond interest rates peak so high before falling back down to within this channel and back to the floor level? Well, I believe that has to do with all the COVID government and emergency stimulus spending that was going on in the early part of this year. So there was a lot of infrastructure bills that was being passed and talked about, as well as emergency funding and stimulus payments to people and citizens to basically spend money. So a lot of people were out of jobs, so it was COVID pandemic assistance bill. And so naturally speaking, this was in the realms of trillions of dollars of spending that was floated. And so the idea was that the government debt could explode from this, which means there would be a lot more bonds that would be supplied out into the market. And then with those bonds being supplied out into the market, that would, of course, raise interest rates. And I think there was some speculation that was going on because of the Biden administration's appetite for more and more government spending relative to the Trump administration, even during the crisis of the pandemic shutdowns. So the question becomes, why did they have a sudden change of heart? Why did they all of a sudden start saying, wait a second, these investors are like, wait a second, these bond interest rates are too high, the bonds are too low, I'm going to buy government bonds? Well, there's several things going on. So the first off is in general, even though the government has been spending a lot of money, quite frankly, Janet Yellen at the Treasury has been holding the debt levels of government relatively low. Debt has not increased all that much in government right now. So for the past 6 months, total government debt added to the economy has really not left anything more. It's not reached anything more than about $700 billion. Okay, so let me be clear here. Since the beginning of this year, our government has basically raised about $750 billion of debt. Well, what happened to all those trillions of dollars of stimulus spending that was supposed to come out? I think it's time that we do a little bit of accounting and see what happened with all that money to gauge what's going on in the bond market. So first, let's talk about the government debt. So this is your government debt that's out circulating to be held by the public, okay? This is not to be confused with the total government debt, which is in this column right here that I've highlighted. This is your total government debt outstanding. The difference between the debt that's circulating out to be held by the public is what is called intragovernmental holdings. Let me break this down to you in real simple terms. You know the Social Security Trust Fund? That's what's invested in the Social Security Trust Fund. The Social Security Trust Fund, your payroll taxes that you pay every single month, goes to buy government debt. That's what's invested. So the federal government collects payroll taxes and sits there and buys its own debt with its payroll taxes to cycle out some of that debt off the markets. It's a Ponzi scheme because the Social Security Trust Fund is going dry and it's going bankrupt because the interest returned is very paltry and it's not even invested in any kind of real return on an investment that causes any growth in the economy. But I digress. So here's your total debt held by the public. Take note of what this amount is, and we're going to go to the end of June 30th, okay, because most of the data that I've gotten is up to the end of June, since July's data is not finished yet and is not out since we're in the middle of July. So take note here. So here's your debt outstanding to the public. It's $22 trillion, $330 billion. Look at what it was at the end of March when interest rates peaked on government debt. It was $21 trillion, $990 billion. So that calculates up to a difference of $340 billion. So in the past 3 months, when these bond interest rates started to fall, when government debt interest rates on the 10-year fell from 1.75 to 1.3, we merely had an increase of $340 billion. Now, annualized, that's still an exceptional amount because that's like a $1.3 trillion deficit. However, it's not to the degree that I think that investors feared. I think they were expecting hundreds of billions of dollars of debt to be created in a few months, and that just did not transpire. Now, one of the things that we need to take into account here, of course, is the debt that the Treasury debt that has been purchased by the Fed during that time. So the Federal Reserve has purchased debt. Now, naturally speaking, and I've already done these calculations for you, naturally speaking, the Federal Reserve has been committed to buying $80 billion of government treasuries every single month. So 80 billion times 3 is 240 billion. Then I looked at the change in total Treasury holdings at the Fed. And this is what it was at the end of March 31st. It was $4,940 billion of Treasury securities held at the Fed at the end of March. And then as of the middle of July, it increased to 7.625, okay? Or, I'm sorry, 5.2 trillion. So there you have it right there, about $280 billion of debt, of this debt, was purchased by the Fed. So now we're down to only $60 billion of new government debt added into the economy to force up interest rates from where they were at the end of March. And yet, here's the amount of government debt that was purchased by commercial banks. Okay? So there was about $75 billion that was purchased by commercial banks during this time. And then lastly, there's about $105 billion that was purchased by foreign investors and foreign banks, noted by this chart here. So at the end of May, and this only goes to the end of May, so the total amount has probably changed. There was a grand total of $7.135 billion of government debt held by foreign countries, okay? And then at the end of March, that was only $7.028 billion. So about 105, really close to 110 billion, and possibly even more, considering the changeover in the past few months, is actually held by foreign investors. Really, if we were to chart this out, it looks like it's going to be about 150 billion if we were to go out to the end of June. So I'm just going to change this up to about 145 billion dollars to give that, to represent that increase. And so that means that total wise, 160 billion dollars less government bonds are actually circulating out in the market from where they were 3 months ago. So there's less government debt, relatively speaking, and that's what we can account for, okay? That's not counting all government debt that was purchased during their time. So there's other private holdings. In addition to commercial banks, you may have investment banks that have purchased government debt that we don't have those records for, okay? Then there's your private investors, your private individual investors who are buying government bonds. They may have bought some of this government debt, most certainly would have, and that would have increased this negative account for it even further. So quite frankly, there could have been hundreds of billions of dollars of bonds circulated out, taken out of circulation, and that was probably because of an expectation, I think, that there was going to be more debt flowing out at this time relative to less. Now, some people have wondered and started to speculate that maybe because of a pessimism of the U.S. economy that has caused investors to flock to government bonds to hold them as safe havens. Possibly. Possibly. One of the dichotomies is that although inflation rates are rising, there's given an expectation that the Fed will raise interest rates, which of course would put upward pressure on bond interest rates, but there's the fear that it would cut short the recovery and tank the economy. That would put the economy in recession, which would lead to losses, real losses in investment holdings in the U.S. stock market, which of course would then flock to bonds. And then there's of course the idea that if you raise interest rates, it temporarily raises the cost or the opportunity cost to holding stocks, which puts downward pressure on the stocks. So ironically, that can help keep interest rates and lower them back down as well. But I do think the major cause, though, is because investors were expecting more debt than they really got to circulate out in the economy. The question becomes why, and I believe this has to do with Janet Yellen at the Fed, okay, or Janet Yellen at the Treasury. So take note here that at the end of March 31st, right, this was the Treasury's general account, okay? And then in 3 months to June 30th, that general Treasury account was drawn down by almost $300 billion. So Janet Yellen herself has been managing a lot of this government spending because with cash that's sitting in the Treasury's general account, okay? Here's your stimulus bills times, right? This is when the stimulus bills were being pushed out, and look how much cash was flowing into the general Treasury account. There was an increase of almost $1.4 trillion of revolving cash going into the Treasury net of its expenses. And that was because of all the debt that the Trump administration levied out in the wake of the COVID pandemic early on. And so since then, the government has been floating on large cash balances at the general Treasury account. So this kind of helped finance Biden's stimulus bills, because when Biden passed his first stimulus, right, here's the drawing down of cash payments. It really just took $1 trillion out of that general Treasury account. Unfortunately, that also means that this trick can't be replicated twice. If another stimulus bill comes out, there remains no more extra money really inside the general treasury account to balance that out, to draw down on. And so, in other words, there will most certainly have to come an issuing out of more government debt, more government bonds, which will force those interest rates up. Even if there isn't any stimulus spending bills that come out, the CBO has projected that our government by the end of this year will run a $3 trillion deficit, which means that if it runs a $3 trillion deficit, sooner or later there's going to be another $2 to $2.3 trillion of government bonds coming out to market. Okay? And that also will put pressure on these interest rates. So you can look at this drop in interest rates as sort of a return to norm. Okay? It's on the low end, no doubt. Look at it's on the floor end, but it's sort of a return to normalcy. So the normal area of where these interest rates were supposed to flow into was perhaps between, say, 1.25 to 1.3 to, say, to 1.4 to 1.5, but it was not supposed to be at 1.75 back in March and pushing upward. So the question becomes, where are Treasury interest rates and generally interest rates going from here? Well, I think they're going to continue to follow this upward trend. And if we were to just chart this out on the low end, the trend is going to look something like this through the end of 2021 and 2022. We see here this drop in interest rates as there was this auto correction that was made, and now we're going to see, because just sheer amounts of spending, inflation, and just government debt coming out to market, I think we're going to see these interest rates start to push up over time, and probably sometime by the end of 2021 it's going to approach that 2% threshold, and then in 2022 the 10-year Treasury is going to be well over 2%. One of the interesting things to note, and I learned this from an economist down in Texas. He's a professor for a college down there. His name is Benjamin Faust. I'll put a link to his YouTube channel for econ in the description of this video. But he pointed out to me that there was a direct correlation between the 30-year fixed mortgage rates and the 10-year Treasury rates. So I did the research on this, and sure enough, it was right. And the trend tends to be that your 30-year fixed mortgage rates is about 1.5% above your 10-year Treasuries. So as 10-year Treasuries are getting forced up, not only will long-term government debt get forced up in interest, but mortgage interest rates will be forced up. And that could pose potential problems to the housing market in the long run, as borrowers are going to have to spend more to pay for their houses. In a video, I'm going to go over how this could lead to higher inflation numbers than even what we're seeing now in the CPI, which kind of bolsters the whole narrative that we're in an inflationary environment. Now, having said all of that, this can definitely pose problems and also adds to the bearishness of the stock market. But I wanted you just to take note of, what's been going on with these interest rates in perspective. Yeah, they dropped for the past 3 months, but the long-term trend over the year is still pushing upward on these bonds, and I think that's going to continue. So guys, if you have any questions for me, just leave a comment down in the video below. Make sure that you hit like and subscribe to my channel if you enjoy this content. And if you guys have any suggestions on what topics that you want me to cover, I'm all ears. The next video that I'm going to go over is probably going to piggyback on these interest rates, and I'm going to showcase to you a model that I created that is able to predict recessions based off of credit defaults. And I'll use that model to kind of project what's going on in our economy now and where we're headed in the next few years. So stay tuned for that, and I'll probably drop that video into YouTube probably tomorrow. So guys, thanks for watching, and I look forward to seeing you in the next video.